We would like to welcome everyone to the world headquarters, Henry Wealth Management in Bridgeville, Pennsylvania. We got a couple gurus here in a second, but we are entitled today, Fear Proof Your Investment Journey. Fear, and there's a couple kinds of fears we're going to talk about, so stay tuned for that. You'll see. But right now, and by way of introduction, you know and you love Greg Trzaski. Greg's done several webinars with me. He's been in Pittsburgh a number of times, met a lot of our clients. You know him, you love him. He's a big guy. He's a smart guy. He's now a senior regional director at Symmetry. You've been there 8 years, right?
Correct.
We love Greg. But you haven't met Mike Storer. But I've known Mike for 17 years. I love this guy.
Yep.
He's a Boston guy. Tonight he'll be cheering for the Pittsburgh Pirates.
That's right, Phil, I will.
But he's a Boston guy. We love him. Wife, 2 kids. Your kids are in their 20s. Your kids are in their like 2 and 5, right?
Correct.
So youth, experience.
There we go.
You guys know me. So, hey, thank you. Fear-proofing your investment journey. We're going to talk about this. Now, I want to start with a slide with a guy that I've known for a long time. I was privileged to share a stage with him once. I was the warm-up guy, believe me. He was the guru. Nick Murray has written 13 books on finances, and he speaks to a lot of advisors. And this is a very important quote of Nick Murray. The dominant determinant of real life long-term investment outcomes is not investment performance, it's investor behavior. Investor behavior is a key component of the success that anyone will have in their future. Not so much that the returns do 8%, 9%. It's the behavior of the investor that really matters. And that leads us to a conversation of behavioral finance.
Sure.
And Mike, many people call you the professor because you've been doing it a long time. But Mike is going to tell you what behavioral finance is.
Sure, thanks, Phil, and happy to be with everybody today. Sure, investor behavior or behavioral finance is a huge part of what Symmetry focuses on with our investors and with our clients. And simply put, what behavioral finance really looks at is the study of the influence of psychology on the behavior of investors and practitioners like Phil, and ultimately how that impacts the markets. It was actually put forward, much of the research there was done by a gentleman named Dan Kahneman. Dan is interesting in that he won a Nobel laureate for his work. He's a psychologist, and he actually won that Nobel laureate for his work in finance. So he was looking at the intersection of psychology and finance and how it impacts investor returns over time.
And that plays into the 2 parts of the brain, right?
That's right.
And I think Greg's going to really quickly show us those 2 parts of the brain.
Sure, I can do that too. I'll look at this.
He's driving the show here. Well, tell us all the 2 parts and how this plays in.
Sure. So, you know, in the study in psychology and study of research, they look at the brain. And I think we all intuitively know that there's 2 parts of the brain. There's the kind of the fast intuitive part of the brain, which we call the limbic system. And then there's the other, what we call, that's the emotional side of the brain. And then the other side of the brain would be considered the cognitive side, which is the slower, more analytical side of the brain. So both of these sides of the brain can impact how we view things and how we look at investing, if we're looking specifically at that topic here today. You know, they're all biases, whether it's on the kind of the emotional side or on the cognitive side, but they're all predictable. So which makes the average human and actually the average investor, Phil, irrational, which is kind of interesting from that standpoint.
And so there was a rationality, there's fears involved, but I know there's 20-some biases they've identified.
Sure.
Show us that list, Greg. And Mike, tell us, I mean, I know you're picking a few of these out.
Sure, there's many different kinds of biases, but some of them overlap each other. But I just looked through the list here, Phil, and I think of things like loss aversion. Everybody doesn't want to lose money. We know that, right? I look at hindsight bias. Boy, if only I had bought in that particular stock before it went up 100%, right?
Armchair quarterbacking.
You're right. Anchoring on specific things that you think are right, right? The other one I like a lot is bandwagon effect, right? We see a lot of that in investing, where my friend or my neighbor or my uncle told me to buy the stock, or we see everybody flowing into a particular sector because it's hot right now.
We're going to talk a big example about that in a little bit.
Right. But the biggest one, I think, and I'm going to leave Greg to talk a little bit about this, is something that we see called the recency bias. And I think a lot of that is in the news today, where we see a lot of people thinking about what's been hot lately, and they think about that in terms of investing rather than thinking about the long term. And I think Greg has some good ideas about kind of how we can focus on that.
And as we talk about recency bias, I think the kids coined a phrase called FOMO, fear of missing out. And that's a similar concept, because fear can be, well, I could have done this, why didn't I? Or I could lose. So fear, it can go either way. But specifically on fear of missing out and recency bias, talk to us, Greg, about the S&P 500 and what it looked like over the past 5 or 6 years, but what some components of it did on a positive side and on a negative side. Talk to us about that, Greg, please.
Absolutely. Thanks, Phil. Thanks for having me today. You know, as investors know, right, and as you as a financial advisor, most investors in the United States are going to look at how the market's doing and benchmark that to the S&P 500, the 500 largest stocks in the United States. The reality is that while there's 500 stocks within that index, it's actually a pretty concentrated index. About 25% of the index is made up of the top 7 stocks, give or take.
Let me let people dwell on that. 7 stocks make up 25% of the S&P 500. So the other 495 stocks make up the other 75%. So that's a huge amount that 5 or 6 companies comprise.
Sure. One of the interesting stat with that, not only is from a market cap perspective, 25%, but the return so far through June of a very small microcosm of stocks in there accounted for about almost 40% of the return of the index as well. So huge market cap and very small concentrated set of stocks that are driving most of the return of that index.
Okay, so let's talk about how it thanks. What happened over a long period and then over a couple of shorter periods, and how we could lose out on both sides of the equation. Take it away.
Absolutely. So, you know, what we're looking at here is a chart of returns of the S&P 500 versus about 6 or 7 other stocks, top stocks that have made up the top of that index. And so from 2015 through the end of 2021, Phil, the S&P 500 had a cumulative return of about 131%.
And it's hard to see on this slide here, but that's the bottom line, right?
Mm-hmm, correct.
Okay.
That's all the way at the bottom.
Okay, that's the end, the big index, 500 stocks.
500 stocks, 131.5% return. And it's at the bottom of this list.
Right.
So all of these stocks are within the S&P 500. And let's talk about what was driving that. So we can see here, Tesla, for example, up 2,280% in that same time period. You had Apple up 543% during that time period. Amazon up 974%. And NVIDIA, which is a company that people are just starting to hear on the news. I think it kind of flew under the radar in years past. They're a chip manufacturer, and they're experiencing some significant growth. 1, because of the chip shortage throughout COVID. 2, with the surge in AI that we've been experiencing this year.
Okay, so they're a big AI player. I got you.
Big AI player, up almost 5,800% in 6 years. I think everybody would love that return, Phil, right? That's in your portfolio.
Okay, so
right?
So this was 2015 to 2022, S&P up 131%, but a small part of that S&P, and so some people start to look at that small segment and say, I'm missing out. I'm going to start to overweight to that area because look how well I'm missing it.
Yeah.
Okay, tell us what happened.
Up, you know, as an advisor, Phil, you're getting calls. Hey, how come we're not heavier in technology? Can I buy more of NVIDIA or Apple, particularly? Right? And why do we recommend against that? Why do we maintain that diversification? Well, let's look at what happened in 2022. You know, inflation goes sky high, the Fed starts rising interest rates, war in Ukraine, not favorable, especially for a technology environment. The S&P 500, still a concentrated index, but diversified, down 19.5%.
Okay, and that's the top line of those other 6. So that's the top, that's the best performing loser.
Yes.
Down 19%. What about those other 6 stocks?
So what's pulling it down? Those same stocks that pulled up the index the 6 years prior are now the biggest losers. You have Microsoft down 29%. You have Amazon down 50%.
In 1 year.
In 1 year. Apple down 27%. And Tesla, right? What everybody was talking about, everybody wanted on the Tesla train, recency bias. It was doing well. We want to jump on board. Tesla down 65%, Phil. And so I ask for most clients that are approaching retirement, they're getting into retirement, they're using their IRAs for distribution purposes and income. Can you stomach a 65% downturn in your portfolio? I don't think that's something that a financial advisor would be recommending that their clients put themselves in that type of risk.
Okay, so let's just press pause for a second. You see these 6 stocks really drive some investors, not ones that work with us, some investors start throwing more and more money into those 6 names. Then they get their clock cleaned in 2022. Okay, the S&P down 19 looks attractive relative to these ones. So then they say, get me out of here, this isn't working. Then what happens in 2023?
Exactly. So we had after, 21, 20 into 22, everybody wants on the bandwagon. They're buying in high. Now into 2022, everybody says, well, I'm down big bucks, so I want out. So now they've lost a lot of their money. And what happens the following year, right? We see the S&P 500. This is through the end of July here, up about 18%. Again, the bottom line on the chart. And what has driven markets this year, at least through the first half of the year, we saw Microsoft up 43.5%. We saw Amazon up 55%, Facebook up 144%, NVIDIA, again, 204% return in 6 months. That means it's on pace to have about a 639% annualized return. 1 year, 639%.
Okay. So here's the bottom line. Our people, our friends here, the clients that are watching, fear. We don't want the fear of missing out, so I'm going to overload. We don't want the fear of losing, so I hurry up and sell, because we're going to build balanced portfolios that can weather those storms. We're not going to hit a home run in the good years. We're not going to strike out in the bad years. We're going to be somewhere in the middle. We'll talk more about that in a second. But there's just one more really intriguing example to me. So let's not talk about just the S&P and 6 stocks. Let's talk about a broad-based mutual fund and an all-star, rock star manager. Tell us, Greg, about Ken Hebner and what happened from 2000 to 2009 with this rock star investor that everybody wanted. Tell us about him.
Yeah. So I'm not sure if anybody on the webinar right now is familiar with Ken Hebner, but as Phil said, he was the rock star investor. He was the guy that you wanted to be with in the last decade, January 1st, 2000 through December 31st, 2009. For those of you that remember, we had the tech crash at the beginning of that decade.
Right.
We went through the 2008 financial crisis,
yep,
right, and all the bank failures and whatnot that came associated with that. And so the S&P 500 over that 10-year period had an average annualized return of -1%.
And to put that in perspective, make it simple, you started the decade at 100,000, you ended the decade at 90,000.
$90,000. So you would have lost 10 grand out of your $100,000 investment by buying the diversified index. Ken Hebner's CGM Focus Fund over that same time period had an 18% annualized rate of return.
So he outdid the index by 19%.
Mm-hmm. Yeah. Now I'm going to pause for a minute. I want everybody that's listening in to think to yourself, right? What do you think the average investor in Ken Hebner's CGM Focus Fund that produced an 18% annualized rate of return, what did the average investor receive as their return?
Let me just tee this up one more. So if you bought Ken Hebner at the beginning of the decade, at the end of the decade, you sold him, you made 18%. That's what you made. If you bought and held, all right? So the fund earned 18%. What did the average investor in that fund do?
Mm-hmm. You ready?
-11%.
-11.
All right.
The average investor. Help us. How does that happen?
Yeah. So Wall Street Journal actually interviewed Ken Hebner. This is where the statistic was brought out. They interviewed him at the end of the decade, and they didn't tell him that this is what they wanted to talk to him about, but they pulled it out. They said, "Hey, Ken, what do you have to say for yourself?" And Ken Hebner's response was, "I did my job. The investors didn't do theirs. They should have been with me the entire time."
Amen.
Right? And he's 100% right.
Yep.
Right? So that is how investor behavior can impact your returns, right? And so I think, the last few slides, right? People are probably seeing Phil, NVIDIA, Apple, Tesla. Hey, maybe we want to jump on the bandwagon, right? This isn't a perfect example of what it looks like when you're getting in and out of things at the wrong times. And usually when you want to get into something, it's the wrong time.
Yep. So fear of missing out, so I'm going to buy more. Fear because it's going down. I'm getting out, missing out, getting out. That doesn't work here. We build something and then we hold it. And you can live with it. We rebalance to it. That's what we do. But let's talk more about a more recent fear item. And recently, in the past couple of weeks, the U.S. credit market gets downgraded. That's our current fear. We're not going back 10 years, 20 years. That's last week.
Yeah.
Mike, talk to us about the U.S. credit downgrade. what really is it? What does it mean, and how should investors react to it?
Sure, I think it's a great point you make, Phil, is that, the Ken Heidman story that Greg just shared is an older story, but it can run through time. But even today, there's all kinds of reasons why people might want to be in or out of the market, and more specifically, the U.S. credit downgrade. We just found out that banks got downgraded recently this week too. So there's other news that's out there. So, for those of you who are not familiar, I'm sure you are, Fitch downgraded the U.S. credit ratings from AAA to AA+ on Tuesday last week. The downgrade sparked a fire rebuttal from the White House. Looking at some of the financial pundits out in the marketplace, a lot of them said it was largely unnoticed by the markets in a lot of respects, right? There was a lot of complacency, and some think maybe the complacency is misplaced. Could impact the 2024 elections. Sometimes the market or investors or different types of investors want to capitalize on that fear. But what I would say, in terms of thinking about this particular situation as well as the bank downgrade, is this is just another reason why people need to have a financial advisor, need to focus on the things that are important when it comes to investing. Because even though this downgrade is here, this may actually be a positive in that it might slow the borrowing of the U.S. government. So you can look at both sides of this situation, in that the markets kind of looked at it and really kind of largely unnoticed what was happening. But at the same time, it might be a shock to the government that, hey, maybe we ought to slow the process of borrowing, and maybe the markets will look at that and say that's a positive in some ways, which is in an intuitive way doesn't make sense. But that's kind of why trying to figure out what markets are going to do is difficult, because sometimes intuitively markets will do the opposite of what you think they're going to do.
In fact, Phil, I love the quote at the end here. Jamie Dimon was one that jumped out at me on his speech. He said, it doesn't really matter that much because it's the market, not rating agencies, that determine borrowing cost, right? So he's saying it doesn't matter what it is, we're all going to be fine. But let's look at the responses to the market. Mike talked earlier about the limbic system being fast and intuitive versus your cognitive side being slow and analytical. What have we experienced since this news came out? We've had almost, maybe going on 5 straight days of the market having some, turning downwards, right? So what's happening right now is that news is sparking your limbic system, that fast and intuitive thinking. People are getting fearful. So what do? They start selling. That brings down the cost of the price of securities, right? And so the market's going down. Now the slow and analytical side, your cognitive side, which should be saying the opposite. Well, let's step back. Let's think about this, right? Markets go up over time, right? They go down. This is just that short-term news. This isn't a sell-off opportunity. That's how you lose your money, right? This is a buying opportunity. Now this news, you can take advantage of what other investors are doing, not for behavioral finance. Buy low and increase your return.
So that reminds me of the Seinfeld episode, George Costanza, opposite day.
Yes.
Right? And on that particular episode, instead of lying like he always did, he told the truth, which was opposite for him, and he ended up getting a date, right? Telling the truth, which was opposite. So opposite would be, you read this news, buy something. But you know what? Let's do this. We've talked about previous fears, and I should have gotten that, I should have gotten out. We talked about current fears here, the downgrade. Let's talk really about what we can control, okay? Things that matter, things you can control. There's an intersection there. And so we want to talk, what can we control? And before we dive into this, I want to pull up this next slide. Greg, we call this the power of diversification. We call it the periodic table.
Yeah.
And I want you to speak to this table. It looks like a quilt. And it looks like a quilt on purpose. Each of these boxes represent a different large cap, small cap, international, emerging markets. It doesn't matter what the numbers are. The quilt from high, best performer in a given year, low, worst performer in a given year. Speak to us about this quote and give us an example of why we don't want to be moving based on what this quilt has done lately.
Yeah, absolutely. Phil, the whole point of making a visualization of this chart is to show investors that there is no rhyme or reason. There are no trends. You hear about this all the time on the news with active managers and whatnot, doing all kinds of technical analysis, saying, if you get the death cross, this happens. If this chart comes out and markets do this, then this is going to happen. What this shows you is that there is no rhyme or reason. So, 2009 on this chart on the left in the peach color, We have emerging markets at the top, 79% return, right? I'm sure that everybody listening in on this webinar, including us in this room, want that in our portfolio, right? We don't want to miss out on that. Right. Well, let's fast forward just to 2011, 2 years later, it was the worst performing asset class.
From first to worst.
18%. So first to worst in a 2-year period. We see U.S. growth in 2020, right, up 42.14%. 2 years later, 2022, also at the bottom, down 32%, right? And so a lot of these asset classes that we incorporate into the portfolio have some significant volatility. You know, and for the average investor, they can't stomach the volatility. A good friend of ours, former director of investments at research, or director of investments at Symmetry, Dana Dioria, used to say, volatility is the price you pay to capture the returns that markets have to offer. The problem is, and this is why investor behavior is so important, people can't stomach the volatility. People don't have an indefinite time frame to stay invested, right? That would be nice. If there is a trend though, Phil, that we see on this, I'd like everybody to look at the red box. And that's, so your moderate risk 60-40 portfolio. And what you'll notice is that it's never the best performing asset class. It's never the worst performing asset class. It tends to ride right down the middle, right? And so what we're trying to do here, both at Symmetry and at Henry Wealth Management, is give clients the best risk adjusted return. We want to factor in that volatility. We're cognizant of the fact that most investors can't stomach a significant amount of volatility. And so we want to build a portfolio that people can live with, because if you can't live with your portfolio and you're getting in and out of the markets, now you're just becoming the statistic. That's not the good statistic.
Thank you. Good example. So please go forward 2 slides now. Let's go to the critical role of the advisor. And is this a self-promotion? It is, yeah, because we'd like to think that having an advisor, a Henry Wealth, a Phil or a Dan Henry, or another good advisor that you have is going to help keep you in your seat, buckle your seatbelt, stay in your lane, and not try to jump and move around and move based on these fears, fear of missing out, fear of getting out. Stay in your seat. And so this is a study that was done, and this is really similar to that Heatner the fund, how the fund did great, but the investor didn't.
Right.
So Mike, if you would address this. What does this critical role of the advisor, what's the difference between these 6.81 versus 9.65? What does that mean?
Sure, this goes back, Phil, right to what we started the presentation today about, is behavioral finance, right? And why an investor needs to have the guidance of an advisor. And this is something called the Dalbar study, and it's actually a firm right out of Boston, Mass, where I'm from originally, and they put together data, and this is a 20-year study, and they change it every year. This is through 2022, and what it looks at is how the average investor, similar to what we showed earlier with Ken Hemer, how the average investor does versus a typical index. In this case, they're using the S&P 500. What it's showing you here is that the average equity investor over the last 20 years has averaged about 6.81, almost 7%, whereas a simple index, if you just bought and hold that for the last 20 years, you did about 9.65%.
That's right.
So again, once again, behavioral biases impact the return that you get based on, comparing it to a specific market.
So if you buy the index and hold it, if you buy a diversified portfolio and hold it, you're going to do better than if you try to help yourself.
That's right.
Getting in and out. The average investor does worse than the index because, and I think I'm right about this, the average investor only holds something for 3 years.
It's about, correct. It's a little under 3. It's like 2.5 to 3 years
in and out
holding period.
In and out. Now, and then just so final point here is, what's the antidote here? It's to think about where you are in your life stage and to build a portfolio around the life stage. Are you younger, you're in the growth mode, or you're going to be more aggressive? Maybe you might be 80, 90, 100% in equities, very diversified, not so much in bonds. And maybe you're in the more of the protection area, maybe you're getting close to retirement, maybe you're 70, 60% in equities. Now you're in the distribution phase. Maybe you're 73 years old, you're forced to start taking money out of your IRAs. Maybe you're 60 to 50% in equities at that point in time. But that's a conversation we have. We measure that, we talk about that, and then we implement it. And then I just want to end with a couple of very important, as we wind down here. There's a gentleman named Eugene Fama, who's probably familiar to our Symmetry fans because He is a Nobel laureate. He teaches at the University of Chicago. He's very instrumental in the dimensional funds. And he's been a board member of Dimensional for years.
Sure.
And how's this for a cute little quote? Money is like soap. The more you handle it, the less you'll have, right? In and out, in and out, in and out. Just buy and hold it. Quit touching it.
Yes.
Let it go. Important point by Eugene Fama. Next is a quote by yours truly. Mike, would you read my famous quote? Would you please read that to our nice people?
Phil, I'd be honored to. Phil Henry of Henry Wealth Management says, build a portfolio you can live with and then live with it.
And you know, I like to talk about marriage right there because, you know, some you've been married 25, 30 years. But, you know, in that nice period, my wife's not watching this. She doesn't watch my webinars. I love her. I adore Beth, 26 years. But we bump heads once in a while, right? But, you know, the best thing you do is live with it, talk about it, forgive, which is usually her forgiving me, and hold on to what you have and live with it, and you're better off for it. Your portfolio, you're going to get bumped and banged around. There's times you're going to love it, times you're not going to like it. Live with it, you'll be better off for it. And finally, right back to where we started with Nick Murray. Greg, I'll let you read Nick Murray.
Absolutely. So from Nick Murray, the dominant determinant of real life long-term investment outcomes is not investment performance, it's investor behavior.
So the behavior, we can't succumb to fears, the fear of losing out, the fear of missing out, the fear of getting out. We don't want to, we live by fears. We build it, we live with it. I'm preaching to the choir, I know that. You're our clients, you're great people, you've heard these things, but maybe the reason you are settled in up and down times is because we preach. And you hear it time and time again. The scripture says faith comes by hearing and hearing, hearing and hearing. The more you hear, the more the faith. And I think the same is true here in the realm of finance. So you've been a wonderful audience. Thank you very much. Do we have any questions, Greg?
Right now, no, but if anybody has a question, you can input it right to the right in the question box, and we'll be glad to help you out.
And we're going to do this too, because I love to be done within 30 minutes. And right now we're 28. So we're going to cut it off here in a second. Thank you for watching. If you have a question, I'm easy to get to, you know that. And Greg and Mike are here, so we're appreciative. I love you guys. I appreciate you being here.
Happy to be here.
And love our Symmetry Partners. So thanks for tuning in. We love you, and we will talk with you soon. We're here. Email us, call us, and thank you for your business and your trust.